It was an opportunity for open discussion at the FT's Global Commodities Summit in Lausanne, Switzerland. Big names from across the sector debated issues ranging from Iran to regulation. One of the main subjects being discussed here is that of transparency. So much of this sector is run by private companies with minimal disclosure, and regulators are concerned that with trading houses making an estimated $250 billion in the last 10 years, that's more than all of the big Wall Street banks combined, that more accountability needs to be built into the system. Marco Dunand is co-founder and chief executive of Mercuria, one of the world's largest energy traders. He says there is an issue of transparency, but that the industry is realising a need for change.
There's a certain area of suspicion on the industry, and therefore openness, it's something that the industry has to kind of seek to improve. At the same time, there's also certain myths. Some people feel that trading companies, I've seen actually an article in the FT saying, private trading companies are largely unregulated. I've asked my head of compliance to tell me how many regulators do we have to follow across the world, and she counted up to 70, and she says probably more than that. So I think it's a bit of a myth to say that we're not regulated, but at the same time, the industry is probably a little bit guilty of being a little bit closed on itself.
Trading houses are regulated in many ways. Environmental regulators keep an eye on the oil they're moving around in tankers, for example, and futures market regulators watch the trading that they do. But the core business of moving physical commodities between countries is still an unregulated business. That's raised some concerns among lawmakers and NGOs about dealings with corrupt governments, in some cases dealings with suppliers like farmers. Some others have concerns about the impact physical traders might have on the formation of prices of fuel and food.
Geopolitics is always high on the agenda for any meeting of the commodities community. This year, China, Europe and the US dominated.
The economic analysis was very interesting. On the very negative, Europe, general view among speakers and delegates is a basket case. Very positive about the United States, big surprise, particularly the CEOs of the trading houses were very positive about the recovery in the United States. And China, big question mark, so-so. The room was concerned about the slowdown to 7.7%, but even so, everyone was reminding themselves that 7.7 is still a very strong growth by any standards.
I think the key in China is not where the growth is 7% or 8% or 9%, it's the quality of growth. And I think what you're seeing from the policymakers is a realization that growth for growth's sake is not a policy goal. And they're very focused on the quality of growth. Historically, what you've seen is overcapacity in many industries. And I think the Chinese policymakers are focused on changing that and addressing the concerns that come out of that.
Economic slowdowns and a squeeze on bank lending are forcing trading houses to tap new sources of funding. Gunvor, the privately owned oil trader, announced here that it was approaching the capital markets for the first time to raise $300 million. The move is part of a trend among trading houses that is likely to see an increase in their financial disclosure.
I think longer term it will be a market, but there may be times through the cycle where it may or may not be open at competitive pricing. Today, clearly, the low interest rate environment is very conducive to this type of instruments and make them very competitive from an issuer perspective, and also interesting from an investor perspective because they provide yield.
Here in Switzerland, the heart of commodities trading, there's a recognition of an industry in transition. And as new sources of financing and evolving business models spread, so more of the sector is likely to be teased out into the light. Seb Morton-Clark, Financial Times, Lausanne.